Welcome to NAHB's Macroeconomic Outlook for September 2025. Inflation is trending lower, but continues to be above the Federal Reserve's target of 2%. The Consumer Price Index registered a year-over-year reading of 2.9% in August, the highest rate since January. While the shelter component continues to be the largest contributor to headline inflation, it achieved its lowest year-over-year reading since October of 2021 at 3.6%. Additional housing supply is the key solution to tame both housing and overall inflation rates. NAHB is forecasting that inflation will eventually fall back down to 2%, but not until 2027. Moving to the labor market, the economy added 22,000 jobs during the month of August, driven primarily by the healthcare sector. The average number of jobs added so far in 2025 is around 75,000 per month, which is approximately half the rate experienced during the same period last year. Recent revisions to the monthly payroll figures and the annual preliminary benchmark indicate a much softer labor market than economists previously thought. Nevertheless, it is important to note that both actions taken by the Bureau of Labor Statistics are part of the normal operating procedures undertaken by federal statistical agencies to ensure data is as reliable and up-to-date as possible. While labor demand continues to slow, labor supply has also downshifted, causing the unemployment rate to remain relatively stable. NAHB does anticipate the unemployment rate to rise over the coming years, but not above 4.5%. The second estimate on real gross domestic product, or GDP, for the second quarter of 2025 came in at a seasonally adjusted annualized rate of 3.3%. reversing a negative 0.5% reading in the first quarter. The main driver of volatility between quarters was due to trade, specifically imports. One of the four major components of GDP is net exports, which is exports minus imports. A rise in imports causes net exports to be negative, and thus subtracts from the overall figure, which is what we experienced in Q1 this year. On the other hand, a decline in imports causes net exports to be positive and adds to GDP, which is what we experienced in Q2. Consumers and businesses rushed to make purchases prior to the Liberation Day announcements on April 2nd, resulting in a surge in imports for Q1. But this was only a pull forward of demand, causing imports to fall dramatically in Q2. As a result, a better gauge for where the true growth rate of the economy stands is to take the average of these readings, which was a positive 1.4%. While NAHB has increased the odds that the U.S. economy will experience a recession over the next 12 months, we currently do not have one built into our forecast, but we do anticipate GDP to grow below trend at around 2% for the next few years. As of September 11th, the current Freddie Mac 30-year fixed-rate mortgage sits at 6.35%, which is the lowest that this rate has been since October of 2024. While this downward momentum in mortgage rates is welcome news for housing affordability, especially for first-time homebuyers, existing homeowners are still experiencing the lock-in effect. According to the Federal Housing and Finance Agency, as of Q2 2025, the average rate on current outstanding mortgages is 4.3%, and over 85% have a rate below 6%. NAHB is forecasting that the 30-year mortgage rate will continue its downward trajectory, averaging 6.25% by the end of 2026 and around 6% by the end of 2027. With the labor market softening and inflation remaining sticky, this will put pressure on the Fed's dual mandate of maximum employment and stable prices. NAHB believes that the Federal Open Market Committee will give more weight to the labor market, which is why we are forecasting 2 25 basis point cuts to the federal funds rate by the end of 2025. Looking at the remodeling sector, the NAHB Westlake Royal Remodeling Market Index, or RMI, posted an overall reading of 59 for Q2 of 2025. A number above 50 indicates a higher proportion of remodelers who view business conditions as good rather than poor for their markets. The overall reading has been above 50 since the second quarter of 2020. Current demographic factors are proving to be tailwinds for the remodeling industry, such as an aging population, the aging housing stock, the lock-in effect for existing homeowners, and increased home equity due to accelerated home price appreciation post-pandemic. Based on the RMI and these tailwinds, NAHB is forecasting strong spending for improvements in the short term. Thank you for joining us. We'll see you next month.